When do you think the stock market will crash? Predictions for the year 2021. Are you concerned about a new stock market crash? I'll show you why people want to know when the next stock market crash will happen, and why you don't need to be frightened. Finally, I'll give my prognosis for the next stock market meltdown, as well as why it will happen. By the way, I predicted 2020, and I was right. Is it possible that the stock market will crash in 2021? Continue listening to learn more. Before I continue, take a moment to like and subscribe if you find this content to be valuable. A lot of work goes into our videos, so let me know I'm doing a good job. And we hope you watch to the very end to avoid misinterpretation. Overview of the stock market crash. For over 100 years, the stock market has crashed once in a while. Our recollections, on the other hand, are fickle. The next one feels just as unexpected and painful no matter how many times the stock market collapses. What should you do to prevent the next market crash? To begin with, you must comprehend why crashes occur. Where does a stock market crash occur? A social phenomenon is a stock market crash. It is a human-created spiral that is generated by economic events and the psychology of crowd behavior. Stock market crises are also caused by natural disasters and government policies. However, most collapses occur because people spend too much money on things they don't need and buy things beyond their right values. Let's take a look at 5 major stock market crashes in history and examine why they happened in 1929, 1987, 2000, 2008, and 2020, as well as what lessons we can learn to prevent future crashes. The 1929 stock market crash. The worst stock market crash in human history was the stock market crash of 1929. It ruined a generation of people's lives and altered their connections with their families, friends, and the government. But it was ecstasy for the 6 years running up to 1929. For 6 years in a row, the stock market has increased by 345%, and people have borrowed money to buy more stock. The good times felt like they would never end. But all good things must come to an end. The stock market dropped 10% for the first time on Black Tuesday in 1929. And things just got worse. The market proceeded to fall over the next 3 years. The stock market lost 89% of its value from the peak in 1932, at the worst point. The stock market would need to climb back up for another 23 years, or a generation. The stock market in 1928 crashed by 89% in 3 years and took 23 years to recover. The stock market crashed by 89% in 1928, and it took 23 years to recover. Imagine losing 89% of your money and having to wait 23 years for it to be returned to you. Would you be able to hold out for that long? The crash of a forgotten generation 1929 is a picture of inconceivable loss, so awful that it is known as the Great Depression in American history. Over the course of a decade, half of the individuals in the United States lost their jobs, while the other half worked part-time. Beans and potatoes were the only foods available. Men fought over waste barrels as a source of food for their families. The Great Depression brought proud men and women to their knees, and millions of children grew up hungry, without security, and with anxiety. For the remainder of their lives, many people never recover from the trauma. Can a repeat of the 1929 crash occur today? Our fear of what happened to our grandparents is at the root of much of our anxiety about the stock market catastrophe. Can we be affected by the Great Depression? Another stock market fall is inevitable, but another Great Depression is unlikely to occur. This is why. Depression caused by bad government decisions. While the 1929 stock market crash decimated the stock market, other factors unrelated to equities exacerbated the depression. People panicked and withdrew their bank money when the stock market plummeted, causing the banks to fail because there was no federal deposit insurance. People lose not only their stock investments, but also their savings as a result. Then things got even worse. The United States was on the gold standard at the time, and each dollar had a gold value attached to it. As a result, everyone invested their remaining funds in gold. The Fed was concerned that it would soon run out of gold as a result of this, which caused the gold price to skyrocket. In order to improve the dollar's value against gold, the Fed decided to raise interest rates. A huge blunder. Due to extremely high interest rates, all firms were unable to obtain loans, resulting in enormous layoffs, widespread bankruptcies, and the complete collapse of the US economy. An effort by the government to learn from its mistakes. And we've surely learnt our lesson today. Today, we have regulations in place to ensure that we do not make the same mistakes. The FDIC now protects nearly every bank in the United States, ensuring that banks do not run out of money. Furthermore, the dollar is no longer pegged to gold. When the economy is in trouble, the Fed also understands not to raise interest rates. In fact, during recessions, the Fed now intentionally reduces interest rates in order to boost corporate lending and growth. The 1987 stock market crash. The Dow Jones Industrial Average fell 23% in one day on Monday, October 19, 1987, commonly known as Black Monday. This accident occurred on a routine day with no noteworthy news. This was the largest single-day percentage decline at the time. When the crash first occurred, many economists projected that another Great Depression was on the horizon. People became frightened. The smart guys, on the other hand, were completely wrong. Those who managed to keep their money recovered quickly. Those who continued to invest reaped huge rewards. The crash that doesn't happen. We now know that the 1987 crash was caused by a computerized trading glitch, not overvaluation. Someone made a mistake on a stock price, which caused all of the computers to dump stocks automatically. We eventually discovered the error, but the damage had already been done. Since then, we've strengthened safeguards to prevent similar incidents from occurring again. Regulators now have trading curbs or circuit breakers in place to bring the stock market to a halt after significant price drops. 2000 stock market crash.com. Let's talk about the previous tech boom now. Irrational exuberance was at the root of the stock market disaster of 2000. It's a stock market catastrophe brought on solely by the craze for this new technology known as the Internet. That's why it's known as the .com bubble. And there are many parallels between the .com bubble and the current situation. The stock market fall of 2000 was significant enough to need its own guide. As a result, I wrote a second post about the .com bust. But wait. Don't read that. Continue reading this guide and then learn about the .com bust. And then, barely 8 years after the .com catastrophe, another crash occurred. We're talking about the 2008 mortgage crisis, which left the millennial generation scarred. The 2008 stock market crash. The stock market dropped by 50% less than 18 months after hitting an all-time high in 2007. As a result, the 2008 recession began. The real estate market in the United States grew at an unparalleled rate in the years leading up to 2007. House prices in the United States have doubled in just a few years. Persons borrowed money to buy houses with the intention of flip and selling them in a few months. If this seems like something you've heard before, it's because it has. This time, though, it isn't about the stock market, we are in the middle of a real estate bubble. Home prices eventually reached a point where purchasers were no longer interested in purchasing. As a result, property prices plummeted, and plummeted, and plummeted. People become trapped with an unaffordable mortgage and a home worth half as much, pushing them to declare bankruptcy. However, things quickly deteriorated. Bankruptcies in the real estate industry did not end there. Stock market crashes are becoming real estate market crashes due to credit swaps. When a large number of consumers failed on their mortgage loans, the banks that lent them money defaulted as well. And that's when strange things began to happen. In the guise of complex derivatives and credit default swaps, these banks not only marketed mortgage loans to each other, but also to insurance companies, teachers' pension funds, car firms, and other investors. So it wasn't only the banks that had poor mortgage loans anymore, it was now every Fortune 500 firm and people's 401ks. Credit swaps and mortgage derivatives are financial instruments that were created to share risk. However, it ended up putting everyone at risk and causing harm to everyone. And when Bear Stearns and Lehman Brothers, two well-known investment firms, went bankrupt one after the other, everyone else did as well. From banks like Fannie Mae and Freddie Mac to insurance giant AIG and automakers General Motors and Chrysler, the US Treasury Department spent billions of dollars on saving our companies. Hundreds of thousands of individuals have lost their employment as a result of the recession. Lending by banks came to a halt, and investments came to a halt. Despite the fact that interest rates were at 0%, no one was borrowing, and growth came to a halt. Recovery from recession in 2008. For another 5 years, the stock market struggled until resuming its upward trend in 2012. Those who put their money in the stock market for 5 years would have recovered all of their losses. That's not a long amount of time, but it's not as severe as the Great Depression's 23 years. The stock market crashed in 2008, dropping 50% and taking 5 years to recover. The stock market crashed in 2008, dropping 50% and taking 5 years to recover. From 2008, the recovery has been consistent. The stock market, in the United States is on the rise by 2012. Between 2010 and 2017, the stock market price climbed by 215%, representing an annual growth rate of 12% for more than 8 years. The US government passed a sweeping tax cut at the end of 2017, which reduced the corporate earnings tax from 35% to 21%, among other measures. The new law pushed the stock to another all-time high. Many wise individuals believed that the recovery from 2008 had reached its apex by 2016. They had no idea that 2016 would be the start of yet another bull market. A recession happens once every 7 to 10 years, according to historical data. If we suppose that the recession of 2008 ended in 2010, then another one will inevitably occur as we approach 2020, right? 2020 stock market crash. In 2020, I predicted the stock market would crash, and it did. However, I had predicted that the market would crash in 2020 as a result of the tech bubble. I had no idea that a virus would spread over the world and forever alter our lives. An extremely short, self-initiate recession. When Wuhan was placed under martial law in late January, the rest of the world kept a close eye on China. Some have chastised China for being so cruel to its own people. Others were taken aback by its speed. But most people stood there watching as if it would never happen to them. But then something happened to all of us at the same time. Italy began to be on high alert. After that, it was the rest of Europe's turn. The US then went into lockdown in the middle of March. On my last day at work, I recall feeling nervous as I drove home. We looked everywhere online for masks but couldn't find any. I recall going to the supermarket and purchasing a large quantity of rice as well as alcohol wipes. During the first several weeks of the pandemic, my neighborhood was deafeningly quiet. There were no cars on the road, no people on the sidewalks, only the sound of birds tweeting over the brilliant spring skies. The entire universe came to a halt. Except for the heroes. Doctors, nurses, supermarket, restaurant, and delivery employees are on the front lines, putting their lives on the line to save others so that the rest of us can stay at home. Fastest recovery, fastest recession. The market responded adversely when the world came to a halt. We had no idea what was going to happen because we had no idea what was going to happen. Will we all perish as a result of this virus? Will this endure for a few days, weeks, months, or perhaps years? The equities in the travel industry took the brunt of the losses, while the stock market as a whole plummeted. In just 2 weeks, the Fortune 500 stocks have lost 31% of their value. However, something remarkable happened as well. We have begun to purchase items online at an extraordinary rate. Some of us discovered that we can work completely from home. We went over Zoom, cancelled birthday parties, and mourned. We had immunizations soon after that. Moderna came first, followed by Pfizer, and then other vaccinations all around the world. We recognized that the world would never be the same again, but that this new world would continue to evolve. The stock market reacted by enjoying one of the fastest recoveries in the history of all recessions, thanks in part to historically low interest rates. The economy was the first to fall off a cliff. But suddenly, in the course of less than 2 weeks, it was revived from dead to boom. Who'd have guessed? Warren Buffett phrased it this way. The stock market crash of 2020 was an extremely rare recession. It's been narrowed down to a very particular set of industries. Berkshire Hathaway 2021 Annual Meeting, Warren Buffett. This is why recessions and recoveries are impossible to anticipate. Even if you were wise enough to sell your stocks, you might not be able to repurchase them in time to reap the rewards. So, what will happen next? Is the stock market extremely overpriced? As the market moves from exuberance to recession, the stock market tends to swing from overpriced to undervalued. We moved from recession to elation so quickly in 2020 that we're still absorbing it. Is there going to be another correction soon? Do you think we should sell? Because the stock market is currently overvalued, it appears that we should sell because a crash is imminent. If you believe that, you are mistaken. Because there will always be another stock market meltdown, your logic is sound. However, I will demonstrate why you should never sell your stocks in expectation of a crash. I'll tell you 4 reasons why, no matter how confident you are, you should never try to be smart by buying low and selling high. Reason number 1, stock prices vary. The prices of stocks follow a random walk, according to much empirical evidence. This indicates that the day-to-day movement of stock prices does not reflect any pattern. Surprised? You ought to be. Our eyes believe they are seeing a series of ups and downs, as well as some patterns. Even if you know that coin flipping is random, you'll see patterns of ups and downs if you flip a coin every day for several days. Every day, the stock market's course is like a series of random coin tosses. Prices in the past cannot and never have been able to predict prices in the future. If you notice a trend, you're predisposed to detect patterns like the rest of us. Reason number 2, timing the market is impossible. The stock market became theoretically overpriced beginning in 1996 during the dot-com boom of 2000, yet the stock market did not crash until 4 years later, after it had gone up by another 50%. If you had withdrawn your money in 1996, you would have lost a lot of money. In Las Vegas, trying to time the market by selling high and buying low is the same as rolling the chips. You could be years or days ahead of schedule. Be wary of investment tactics that try to anticipate future prices based on past prices by exploiting anomalies. Remember what we learnt earlier, there are no trends, everything is random, thus past prices cannot be predicted. Any profits you've made through day trading are purely by chance. When someone on TV claims to be able to foretell the future, keep in mind that just because you see a pattern from lines on a chart doesn't mean it's all randomness. Even the brightest people make mistakes from time to time. Other than your desire to roll the dice, what makes you a better guesser? Reason number 3, we are affected by both optimism and pessimism. The stock market moves up and down, as we all know. That is all there is to it. However, no one knows when the next downturn will occur or when future growth will commence. Because stock prices follow a random walk, there is no use in trying to time the market. You can get burned if you are overly optimistic about the stock market. A golden opportunity can be missed if you are too cautious. How can we maintain a balance between optimism and caution? How can we profit from the stock market expansion while still avoiding a crash? We actually don't do anything. Research showed that those WHO forgot they had money in the stock market did better than those WHO cared and checked prices on a daily basis. Why? Because the best action is to do nothing. You'll win if you just set it and forget it. Reason number 4, over a long time, the stock market always goes up. We know that stock values have risen more than fallen over the history of the stock market. Growth years account for 75% of total years in the last 9 decades, while decline years account for only 25%. You will make money in the stock market if you keep your money in the stock market for the long term. You'll have a couple of big, heart-stopping, jaw-dropping declines and a lot of little drops during your life. However, if you stick with it, the stock market will go way up on average. So put your money in a broad index fund and leave IT alone to grow. The stock market will crash again, but that will be okay. Nobody knows for sure when it will happen, but we do know that it will. Remember how, in 1987, the vast majority of smart individuals were unable to forecast recessions. Most economists failed to predict recessions every single time IT turns out. Don't pay attention to experts. Don't pay attention to what I'm saying. How do you actually avoid a stock market crash? So, keep reading. How can you prevent a stock market crash? We all know that market crashes happen from time to time and that they are impossible to foresee. So, what are your options? All you can do is try to be neither overly optimistic nor cautious, and invest for the long term as a result. 1. Get the most out of your allocation. When you're young, invest more in equities, and as you become older, invest less. Gradually reduce the risk in your portfolio as you get older. 2. Invest in cash and assets without a correlation. The money you invest outside of the stock market becomes increasingly essential as you become older, especially as you get closer to retirement. 3. Remain in the stock market with the stocks. If you spread your money among stocks, bonds, and cash, you'll be alright in the long run. And perhaps a little cryptography. Have enough cash to last for at least 2 years and leave the stocks alone. Even if a stock market catastrophe is expected in 2021 and beyond, you should never try to time the market because it is gambling. If you're young, enjoy yourself and make long-term investments. If you're approaching retirement, make sure you don't have more than 50% of your assets in stocks, and you'll be good. Get out of your daily stock market vigilance and start living your life. I'm going to keep putting as much money as I can into the stock market, despite the fact that I can't anticipate the market, and that even the brightest people can't, since it moves in a random manner. And if I invest for the long term, I will profit because the market constantly rises. Are you still scared? Thank you for listening, and click on our next video for even more interesting and motivational economic and financial news. You may not agree with me completely, so let me know in the comments. Watch all of our videos, we take pride in bringing you the very best. I am Mark Smart Money, reminding you to stay smart with your money and be excellent to each other. Watch our next video right now. I will see you in our next video.